Today, we have a showdown.
Ooh.
There is, as we like to say in the biz, you can put pretty much anything on a deal evaluation sheet. The question is, are those numbers real? Do they really hold? Do you know your market? Do you know your numbers? Where are your numbers coming from? And at the end of the day, if the data that doesn't make it up isn't real, then the experience won't match. So we are breaking down a deal sheet from a Memphis turnkey rental property provider, or so they say. And we're going to compare it to, we're going to pass it through old GC's Genius Concepts brain over here to see how good the deal sheet is, and then compare that to Jacksonville numbers once we make it real. Welcome everybody to the weekly edition of the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flow. He's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Fantastic to be with you today.
It is good to be in studio today. GC, you came in here with a big smile on your face.
I did. Yes.
Yeah. What's going on? You said you had something to share on the show.
Yeah. So in our Tuesday morning meeting, which is where our team gets together once a week, we often share testimonials. And there was a testimonial that came in over the week that just kind of blew me away, put a big smile on my face. And I wanted to take a minute or so and just read this testimonial to you all. I think it really captures the essence of how everyone can win in this investment, not just you as the investor, but the resident who is renting our home can win as well. This testimonial came in from a resident named Marlene. And she said, "When life took an unexpected turn and a tree fell on our rental home, our family was overwhelmed with uncertainty. Being displaced with 3 children was one of the most stressful experiences we've ever faced, but throughout it all, JWB Property Management showed us compassion, professionalism, and genuine care. I especially want to recognize Shayna and Brandon from the maintenance team. From the very beginning, they treated us with kindness, patience, and understanding. They took the time to answer our questions, kept us informed, and worked tirelessly to help us through a situation that was incredibly difficult for our family. During a time when we felt like our world had been turned upside down, they reminded us that there are still truly people who care. While no one ever wants to experience an emergency like ours, the way JWB handled the situation speaks volumes about the company and the people behind it. Shayna and Brandon went above and beyond to support us, and their empathy made a lasting impact on our family. Thank you, JWB Property Management, for having team members who genuinely care about the people they serve. We are deeply grateful for everything you did during one of the hardest seasons our family has faced." How about that, buddy?
A couple of things come up as you read that. One is, and I'm gonna just list it out as it came up, right? Like, one is, man, anything could happen at any moment in a home.
Mm-hmm. Yes.
Right? Like,
I've seen it all.
And you've seen it all. And at the scale that you guys operate, you've just kind of seen it all, from someone driving a car into a home to a tree branch to like all these other different things
100%.
that we've talked about all the time. It kind of comes with the business. This is a renter, right? This is somebody living inside of somebody's rental property.
That's right.
That's writing this about you guys. That is essentially saying, wow, you guys really had our back in like our toughest moment. To me, as an investor, if I'm hearing something read that way about the property management company that I trust to manage my property, I'm hearing these guys aren't moving from this house,
right?
Unless life changes, right? Like, they're not going to choose to leave this house if you feel this well supported by the people that are providing you housing. Lies in the face of the landlord kind of like
exactly
narrative.
You know, we have the opportunity to flip this whole negative narrative about landlord and tenant completely on its head. You know, we like to think of ourselves as, you know, the relationship driven type of property management company that's not just about helping you as a renter at this season of your life, but we're at the threshold of helping many of our renters become homeowners and tapping into the same type of financial freedom, generational wealth that all of our investor clients get to experience when they own homes. And so when you adopt a different mentality, you have the opportunity to create a completely different type of impact. I think as I read that, she talked about how we made a lasting impact on her family. And our whole goal here is to create an impact on everybody that we get to serve, whether that's a resident, whether that's a client, an investor client, or whatnot. So, you know, and then the other thing that just jumped out to me, when's the last time that you wrote not just a positive. When's the last time you wrote a positive review?
Man, I used a rental company, like a rental car company, like 2 years ago, and I didn't want to punch myself in the face. And I really liked the guy that helped me, so I wrote a review about
There you go.
him. Yeah.
Was it like more than 2 sentences?
No, it was just like, this
I
guy's the
mean,
best. These guys are not a ripoff. They didn't try to upsell me at every moment.
4 paragraphs.
Yeah, 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 yeah.
This wonderful lady
Took some real time.
took some real time to share. So very hard to get positive reviews in any business in today's day and age. And property management is probably more difficult than most. To be able to have somebody who is so touched to be able to write this review, I think is very, very special, and a wonderful credit to our property management team that works so hard to serve our residents on the daily.
And since we got so many new names, I'm assuming that there's folks in the audience. I mean, I know that there's a bunch of folks here with nicknames that come to every show and they're in our community and everything. And then there's a bunch of new folks. Just scope of JWB, you are a not just a turnkey rental property investing company, you're a vertically integrated turnkey rental property investing company, right? So
That's right.
the same people that are sourcing land and deals and renovating the home are the same people managing the home, are the same people that I, as a client, talk to when I'm thinking about buying new things or making a maintenance decision or whatever, right? So this is one arm of your business, 125 employees, you manage 6,000 doors. Big piece of it is property management, because that is the long-term relationship that makes the asset function, which is what we're going to get into today, how the asset actually functions, right?
Exactly.
Do you see? Okay, so let's we're about 13 minutes in, so I want to make sure that we get into this. All right, so the origin of this show is essentially, we look at, we always talk about how these deal sheets are, anybody can put anything on an Excel sheet. Anybody can like claim to bring you returns. We're going to break down a deal sheet that we saw out there from the Memphis market and kind of like pressure test it, because not everybody's going apples to apples. That being said, these are real numbers that we're talking about here on spreadsheets. But this is not financial advice. This is for you to inform yourself, do your own due diligence. What else am I missing in this qualifier?
Not financial advisors.
We're not
just
financial
real estate
advisors.
investors have been doing it for 20 plus years.
That's right. So that being said, 7 things to watch out on a rental property pro forma. Every time we break down these deal sheets, we go over this, right? We've seen over and over the fact that a lot of these pro formas don't include or underrepresent maintenance costs, vacancy costs. Anytime that you're investing in rental properties, you're going to have maintenance. It doesn't matter if it's a new property. You're going to have vacancy. Like, it just happens. Nobody's going to live there forever. They also tend to underrepresent interest rates, down payments, and closing costs. We're going to talk about that plenty today from the preview, from what I saw. They don't include or underrepresent property management fees, right? Like, these are all different things that could be left out that if you're not looking. So this is a great kind of like screenshot that you want to take if you're watching on your phone, or if you're watching on your computer, so that any deal that you're analyzing, go through and check this stuff off, right? Projecting higher home price appreciation or rent price appreciation than is actually historically accurate is something we see all the time. Sometimes underreporting too, right? Just a sign that you don't know your numbers.
Right.
And then they don't include or underrepresent selling costs, right? This idea of like promising you an IRR at the end of 10 years, but if you're underrepresenting it, those are kind of like really big chunks that can drive numbers up or down. And then they inflate the return on investment calculations by including tax savings, principal pay down, and or home price appreciation in year 1. Can you give me a little bit of nuance on that, GC? What do you mean by that?
Yeah, absolutely. So you can really manipulate a higher projected return on investment if you count home price appreciation that doesn't happen for 10 years or 10 or 15 years. It doesn't actually hit your bank account for 10 years, but if you count that in year 1. So, when you're putting in a pro forma together, the timing of the cash flows coming to you is very, very important. Sometimes just as important as the amount of the cash flows. And so what many other pro formas do is they look at the home price appreciation that does happen in year 1, and they say, well, that hits your bank account. But that doesn't really happen unless you sell or refinance a property in year 1, and that just doesn't happen in rental property investing if you want to deliver a profit. So they basically take this home price appreciation that's working in the background and building up over 10 years, and they say, well, I'm going to count that year 1 on your pro forma. And what it does is it jumps up your IRR. It jumps up your projected return on investment. And that's where you see these returns of like 20% or 30% on a pro forma, almost without exception. It's because they have done that little maneuver there to pull forward the timing of home price appreciation or principal pay down or tax savings.
Got it. Yeah, because of the time value of money, supercharging something on the front end will have these like trickling effects that
Yep.
On an Excel sheet you see really supercharge the return as well.
Exactly.
Right?
Yep.
Okay, got it. So again, maintenance costs, vacancy costs, interest rates, down payments, and closing costs, property management fees, historically accurate home price appreciation or rent price appreciation. You see, I think there's a little bit of nuance here. People, how do people fudge this one?
They just put whatever they want on pro formas. You know, you can go back and you can look at what your market has produced as far as average annual home price appreciation or rent price appreciation. You should go back and look over full market cycles. So I'm talking about looking over the past 40 years. And what you get is an average annual rate of appreciation, either for rents or home prices. And what you find is that over time, that next market cycle, you're likely to have a very similar amount of home price appreciation. And there are some markets that grow more, and there are some markets that grow less. And so a common thing that people will do, especially over the last 5 years or 10 years of rental property investing, home price appreciation rates have been a lot higher than the historical norm. And it's just not sustainable.
Mm-hmm.
So if you really want to fudge a pro forma, just go and do a average annual home price appreciation rate for your market over the last 8 years.
Yeah. And
you'll get a really high number, probably 50% higher than what the historical average is, and go plug that into your pro forma. And that's how you go from a 10% IRR return on your pro forma to a 25%. Yeah. And so that's a very easy, it's a keystroke.
Yeah.
And you can do that but it's unsustainable. It's very unlikely to think that home prices will continue to appreciate at that same rate. And so it ultimately sets investors up at a huge disadvantage because they're unable to hit these very lofty return projections.
And easy to fall for because there's truth in it, right? Like if over the last 8 years, your home price appreciation has been X,
right,
then being like, this is what it's been, this is what you can count for. This is what sets people up to fail based on this idea that like, hey, what happened last year is what's going to happen next year. It's not necessarily the truth. It's really what's happened over the last 20 years will happen over the next 20 years in real estate investing. So full market cycle numbers, big deal. All right, GC. So let's jump into the specifics of this property deal sheet. As soon as I find my cursor here that we're looking at here. So this is a turnkey property in Memphis, Tennessee. This is being actively advertised and sold on the internet. We got this off of somebody's active webpage right now. This is a new construction home in Memphis, Tennessee, with a purchase price of $196,600, property taxes of $1,966 a year, household income of $100,000. Why do they include household income?
I have no idea. Okay. I couldn't figure that out.
All right.
I don't know.
Rent increases, assuming 3% rent increases, new construction appreciation of 4%, tax increase of 3%, lease renewal fee of $200, insurance year one of $768, a vacancy rate of 5%, 4% appreciation, 5% maintenance, resident placement fee of 50% or 1 month's rate, and a management fee of 5%. You see, I see that you highlighted rent increase, new construction appreciation, resident placement fee, and management fee. Can you talk me through why you have these highlighted in the first?
Absolutely. Yeah. These are the things that I wanted to point out that can either be overestimated, underestimated, but things that just don't jive either with numbers that I was able to pull or just experience. Let's start with this appreciation thing. We've done this probably, I don't know, 5-8 times now. Have you ever seen a new construction appreciation and a normal appreciation rate there?
I have never seen a broken out home price appreciation for new construction. And then what I'm used to hearing from you is new construction is only new construction when you first move into it. The moment that anybody moves into it, it's no longer new construction.
Right.
And it's really the market appreciates the same way.
Right. That is very true. Yeah. Right. I mean, new construction and existing homes have a very similar rate of home price appreciation over a full market cycle. Yeah. But this is a unique thing that I have seen. The best that I can understand as to what they're doing here is they're counting home price appreciation for new construction properties at double the rate of existing inventory. And it just isn't very apparent here, but as I broke down their pro forma, they're actually counting 8% home price appreciation for the new construction home and 4% home price appreciation if this was an existing inventory home. This happens to be new construction. So it's a little sneaky way to you don't put 8% home price appreciation.
Yeah, so nobody bats an eye.
You put 4% for regular standard appreciation and then like a 4% bump on top of that to new construction appreciation. Doesn't jive with me. Doesn't make any sense. To think that a home in Memphis, Tennessee is going to appreciate 8% a year for the next 10 years is extremely, extremely unlikely.
So is there no difference between new construction and like a renovated home? I mean, I guess if I'm thinking about the difference between new construction and a renovated home, I think of number one, when somebody buys a new construction home, they do pay a premium because it's new, right? So I would say the price is higher, and therefore, all things equal, if I have a home that costs $50,000 more than another home, and they're the same floor plan, whatever, but one is new construction, I don't know if these numbers hold up, and it's 4% home price appreciation, then like the appreciation I get over the whole piece of the pie is going to be bigger because of the bigger price.
Sure, but you also had to put more money into it. Yeah. So as we're thinking about it from the return on your investment from the home price appreciation, it's basically the same.
It's equal. Okay.
Because you had to put more money to get in. And then to your point, yes, on a percentage basis, your dollars from home price appreciation will be more.
Okay.
So I think at the heart of your question is like, do you get a better return on appreciation or return on investment from home price appreciation if it's a new construction home or it's a renovated home? The answer is no.
Okay.
You're going to get largely the same amount of return on investment from appreciation, whether it's a new construction home or a renovated home, because I've seen this. We've been managing homes for, 20 years now. And like we say often, it's only known as a new construction home the first year. And then, a few years later, it's not really referred to as new construction. By year 5, it's not new construction. Year 7, year 10. And if you're thinking about holding on to this for a full market cycle, you're not going to refer to this as new construction anymore.
Okay. All right. So that's the first thing that we see. Talk us through more of these highlights.
Yeah. So then rent increases on that side. I did some research. I should probably share with you the Memphis historically accurate average annual home price appreciation rate is 3.2%.
Oh, okay. So it's not even the 4% that is the baseline.
Not even 4%.
Okay.
So that's looking back over 40 years and seeing what Memphis's home prices have done, which is likely to be what Memphis's home prices will do over the next 10 years, 20 years, however long this is held. So way overestimated on home price appreciation.
So from 8% down to 3.1%, 3.2%.
Yes.
Okay.
Exactly.
Okay.
Exactly. And then on the rent side, I did the research. The average historical annual rent price appreciation for Memphis is actually 3.4%. So we see this often as well. Some providers just don't know their market as well, don't have access to the same data. But yeah, so they actually underestimated their rent growth. It would be accurate to put 3.4 there, which would actually increase their return on investment, but they're underestimating there.
Okay. All right. So maybe it's an under promise over deliver moment for them. Maybe they don't know their numbers, but as you start to kind of like widen out and you see all these other funny things happening in the numbers, it's more likely that piece. Why'd you highlight the resident placement fee of 50% of 1 month rent and the management fee?
Well, so I highlighted this because what you're going to see is that this property management company focuses on 1-year leases. And so one thing to watch out for when you're making a decision with property management is you can go for the low cost, which is maybe a 50% placement fee, 50% of the first month's rent. Whereas a premium provider like JWB, we charge 1 month's rent. But the reason there's value there is because we sign 2- and 3-year leases, and our average duration of resident stay is 4.5 years. So if what you're going to see here is that they have a lease renewal fee and probably will have more property turn costs down the line because they only sign 1-year leases. So be aware, if you're only signing 1-year leases, you're setting yourself up for higher maintenance costs. That's what I wanted to point out there. But here's an example where 50% of the first month's rent is being charged for tenant placement fees. And that is also very common in the industry to sign 1-year leases and 50% of tenant placement fee, but it usually doesn't work to your benefit.
The 5% management fee, GC, as I've gotten to know the property management industry and I go to all these different conferences and whatnot, I feel like I meet very few people at conferences that are charging 5%. They're more like complaining about people charging 5%.
So you're right. Hard to run a premium property management company and deliver a wonderful experience to a client if you're only charging 5%. Industry standards 10%. What's going on here is this is an incentive that they're offering.
Okay.
So for the first 5 years, they're keeping their property management fee at 5%. Years 6 through 10, and however long you hold it, it goes back up to 10%.
Okay. All right. At that 5%, like I keep going back to that review, right? Like the review of having a team that is able to be there for the resident, make them feel safe when something terrible is happening, making them feel supported, as opposed to like having to chase everything and cut pennies and stuff like that. You think for 5 years you'd be able to maintain a 5% property management fee and uphold that level of service? You would have to be a pretty big company with a bunch of other homes under contract. Right?
I mean, the way that they're probably thinking about this is they're offering certain incentives to get people to be able to buy their homes. And it's just a marketing thing. You could give more of an incentive in a cash payment incentive. You could give more of an incentive for a rate buy down, or you could take that little pile of money that you were going to give for one of those other incentives and just count it as a discount to property management fees. And so that's likely what they're doing. Everybody asks, well, what are your property management fees when they're thinking about buying a turnkey rental property or doing property management? So it gives their salespeople the ability to say, well, we're going to work at 5% because that is a common question that a potential client would ask. So to me, it's probably more of just moving money from one place in incentive dollars over to another.
Okay.
So, but I think these are questions that you need to ask. To your point, if this is a lasting model of property management that is at 5% and 50% tenant placement fee, think of that being a very low cost provider.
Yeah. And
that would be a warning sign for me. Here, it's not necessarily a warning sign for me because I happen to know that this is a part of their incentive package. And they do accurately depict that it's going to go back up to 10% later on in the pro forma. I just think it's interesting to note. And if you are thinking about property management services, ask these types of questions because 5% management fees and 50% tenant placement fees are not going to end well, most likely somewhere down the line.
Got it. Okay. So just kind of like the notes, the summary of this thing is the idea that Memphis historical average home price appreciation is 3.2%. And this thing has both a 4% appreciation and then a new construction 4% appreciation rate at 8%. We have the sources there of where you get this data. Joanna will share that in the chat if anybody wants to mess around with that. And also the underestimated rent growth, right? This idea that Memphis historical average of price appreciation is 3.4%. They're estimating 3% for you. So Joanna sharing that in the chat. And then that was like the deal sheet that the cover page, right? This is now looking deeper into the numbers. They have year one cash flow of $487 a month, a total IRR of 13.67% with a down payment of $60,073, year one NOI of almost 14 grand with a monthly mortgage of $791. And then I'm not going to read all these numbers, but you have highlighted here the annual property management fee as something that goes from $876 to $866 to $892 to $919 to $946 years 1 through 5. Maintenance and repairs that goes from 0 year 1 to $456, $469, $484, $498 in years 2 through 5. And then resident placement / lease renewal fees that in year 1 are $738, then $200, then $806, then $200. You want to talk me through some of these numbers that you've highlighted, GC?
Yeah, absolutely. So starting at the top here, when I looked at $487 a month in cash flow and IRR of 13.7%, to me, my first thought is, wow, this isn't the worst that I've seen. A lot of times when we're doing these types of pro forma breakdowns, we see 20% IRRs and 25% IRRs and 30% IRRs. And so the biggest reason, even though as I'm going to detail some of the things that gave me some concern here, but the biggest thing that jumped out to me is at least they understand how to do a pro forma. They understand, so they do not take the home price appreciation that actually hits your bank account 10 years down the road, and they did not put that in year one.
So let's pause right there. A very common practice is to take what home price appreciation is and put that year over year over year into the spreadsheet, right?
Yes.
That inflates your returns because of what we talked about before, the time value of money. This provider did not do that. They are doing a true IRR calculation where they hit the appreciation in 10 years and then they put it in there. So that's good job by you guys.
Exactly. Yeah. I thought that, I mean, their IRRs, when you're buying a single family rental property, if you have IRRs that are over 15%, there's probably something wrong. It's probably some incorrect assumption, way overstating home price appreciation, way overstating the timing of home price appreciation, whatever. So to be in the 14% range, which they are here, I thought that was a good starting point. Now there's a lot of things that are incorrect, unfortunately, in the pro forma, which we'll get at, but ultimately, you know, those top line numbers there are somewhat realistic and believable, which I think is a good thing, you know, as they're selling properties to their clients. So I did want to focus on maintenance and repairs here, and then also the tenant placement or the lease renewal fees, because these are really related. We were just talking about the fact that they sign 1-year leases. I know this because if you look in year one, they have a tenant placement fee of $738?
$738.
Yep. Year two, you see $200. So that's their lease renewal fee. So they are hoping to renew in year two. What happens if they don't renew in year two?
Then you have a turn.
You have a turn.
Paint the walls.
Right.
Maybe replace the flooring.
Same thing for year three. They're hoping to get the resident to sign another renewal. The resident's not locked into anything. They can make a decision to move. So they're assuming that they're going to get them to re-sign. Again, if they had signed long-term leases in the beginning, the resident is already signed up for 3 years. It's not a question if they're going to be there for 3 years. Now there has to be an independent decision. And so then what they assume is that in year 4, that resident is going to leave and they're going to charge another tenant placement fee. And then in year 5, the cycle begins again with a lease renewal at $200. But many individual decisions have to be made by that resident to want to sign up again. And that's a big if. Now,
so let me just poke at this real quick. So then if I'm looking at this and I see this pattern, I see a resident placement fee renewal, pattern that tells me that they are assuming that they're going to have this person in for 3 years, right? Or 4 years.
4 years.
I guess my question then would say, show me your data of where this assumption comes from. Do you guys historically have a average tenant stay of 4 years?
Yes.
Are you just assuming this? Like, how are you coming to this number?
Yes.
How do you incentivize lease renewals? Tell me about what your lease renewal operation looks like. Do you have somebody in charge of lease renewals inside of your property management company? How do you measure their success? Who is this person?
Exactly.
Right? Like, I mean, that would be where I go based on like all the things that I've learned here of how you guys handle lease renewals. And you have a department that's essentially made to like somebody incentivized to figure out how to get lease renewals happening on top of the 2-3 year lease thing, right?
Exactly. It should all make sense. They should have a very high lease renewal percentage rate.
And they should know it, right? Like
they should know.
I'm assuming somebody that's putting on like, oh yeah, we're going to renew these people twice. This is what we do. Like they should know, oh, it's because we have, an 80% lease renewal rate and an average resident stay of 4 years.
Yeah.
Like they should be armed with that data.
Yeah. I mean, their lease renewal percentage would have to be the highest I've ever heard to make this possible. So like JWB's lease renewal percentage is over 75%. And we sign lease renewals when the leases end. Our leases end either at the 2 or the 3 year mark. So in essence, to get to an average stay of 4.5 years, you have to have 1 lease renewal. Here, you have to have 2 lease renewals. So you have to have twice as many lease renewals to get to the same place to have a resident stay through 4 years for this. So if we're 75%, they got to be much higher than 75% to make the math work here. Which I've never heard anybody as high as us. So maybe it's possible. I don't know, but it certainly gives me some concern. I think that is probably your 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 lease renewal percentage here is probably overstated and buried in the assumptions somewhere.
Mhm.
And here's where it really starts to show up. It's not so much what's the fee of lease renewals. Think about what the effect is if and when that lease renewal doesn't happen like it shows on this spreadsheet. And that shows up under maintenance and repairs. Do you see any spike in maintenance and repairs anywhere?
That's where I was going to go. Like I was trying to do the math here.
Yeah.
They're assuming the same amount of maintenance average per year, where I know I'm going through two turns right now.
Exactly. Tell me about that. Is it flat like that?
It's not. Yeah,
No.
correct. I have now with my 5 rental properties had, about 2.5 years with no turns. It's been wonderful. My cash flow has been amazing. Maintenance hits every once in a while, probably spending about $500 a month on maintenance, $500 a year
Right.
on maintenance for things here and there. But when a tenant moves out, there's a series of things that I need to do in order to get that thing ready. And it's more than the average monthly expense. So like when I look at this and I see that they're expecting me to have the same maintenance expense for renewal years as they do for property turn and new placement, like when you get a new tenant in there, new resident in there years, it tells me something's off.
Yeah. So at bare minimum in year 4, you would expect some type of
$1,500.
Sounds very, very reasonable to me.
Yeah.
There's something to think that every time your resident leaves and you put a new one in, that there's not going to be maintenance costs in that year is not real. It's just not. You're going to put money into the property when that happens. So that's not there. I think it's also super aggressive to not put any other spikes in a 5-year period, knowing you're only signing 1-year leases. So that kind of getting to the point that I was just making. But here's the kicker. I know you can't do the math in your head right there, but they're only assuming a 2.5% maintenance cost throughout the entire 5 years of owning that property. I have never seen documented evidence of a 2.5% average maintenance cost for new construction homes or renovated homes or any type of homes over 5 years, over a large period of properties, right? It just doesn't. It's just not that way. JWB's maintenance is 4% for new construction homes. And so to look at that and say, well, number one, probably aggressive because it's only counting 1-year leases. Number two, not showing any additional costs for the year that the resident is replaced, the new resident is put in, not showing any spike there. And then your baseline case is 2.5% maintenance cost over a 5-year window. To me, seems like way artificially underrepresenting maintenance costs.
It's interesting because if we go back to that first screen, their maintenance was at 5% here, right? So like, is there a chance that they put really low maintenance costs for the first 5 years and then if they're putting it at 2.5% for the first 4 out of the first 5 years, then they would have had to have like tripled it for the last 5 years.
You know what they do? Beginning in year 6, it becomes 5%.
Beginning in year 6 becomes 5%, but that doesn't necessarily equate to a 5% over the last 10 years. They just gave you that benchmark.
Yeah, they're saying new construction homes have basically zero maintenance and zero property turn costs when somebody leaves. In essence, they're saying 2.5% for the first 5 years. But yeah, to your point, it's not saying, doesn't line up with what's on the original pro forma first page, which says that you should expect 5% of all rents that you collect over the lifetime. So yeah, man, good catch on that one.
Interesting. So I can see, like to me, the visual of renewals and maintenance not matching up is real. I'm assuming that you also highlighted annual property management fee, because if the annual property management fee stays completely constant, that's assuming that there's never a month that they don't collect. Like why are we highlighting the annual property management?
I just I highlighted that because I wanted to point out it's low today. This is not artificially low. I'm sure this is what they're charging, but that it will go up if we looked over years 6 through 10.
Got it.
So your cash flow will be much different in years 6 because of the increased maintenance percentage to 5% plus the increased property management fee.
You know what doesn't make sense to me though is the fact that if we're looking at year 4 and there is a placement fee, I have to assume that there's going to be a month that I'm not paying property management fee because I'm paying property management fee only when I'm collecting rent, and my house is going to be vacant for, I don't know, man, like a month. I think seems pretty reasonable if I'm turning it, right? So at the very least, it should have like 1 month off on the year 4 annual property management fee, right?
Yeah, that should be right. Not every property management company only charges when
When they collect.
rents are collected.
Okay.
Some charge
Monthly.
regardless if
Okay.
rents are collected or not. So maybe that's how they do it. More likely, though, is what you said. It's just not completely 100% accurate.
Okay. All right. The Pedro Santores has something here on the taxes. Are we hitting taxes on the next one?
We are.
Okay,
We're
cool.
going to do something with taxes.
All right. So underestimated maintenance and repairs, only 2.5% of gross months each year. No property turn costs. This is quintessential to what you were saying. People chronically underestimate maintenance and repairs. We also saw that there's like the psychological trigger of only 5% maintenance on the front deal sheet, but that, like that's not necessarily true.
Right.
When you look at the overall. And then the fact that they only sign 1-year leases, something to really look at. This is something that we talk about a lot on the show. This idea of the name of the game is occupancy, right? So like asking your property management company, asking the turnkey provider, what do you do to maximize occupancy? It makes a lot of sense to think that you put extra work on the front end to sign longer leases. But if you're going to sign 1-year leases, then you better come at me with the world's greatest renewal program.
Yeah.
And the fact that like your entire, like a big investment in your leasing sales force is on renewals, not just getting you new residents in there, and how you do that as well. Right. Okay, cool. So here we are on the next one. You see, we have year 1 cash flow. That hasn't changed. Total IRR hasn't changed. Now we're looking at tax savings, right?
Where they're putting numbers on this pro forma just doesn't, I couldn't make any sense of a lot of it. And I see this a lot. So I guess the suggestion would be, if you're thinking about buying a turnkey rental property with a company, ask them to walk you through the numbers on the pro forma. I think you'll learn a lot. I think you'll probably have somebody say, well, I don't really understand how that's calculated, because a lot of this doesn't make sense. I'm going to point out some of it. Let's start with tax savings. So tax savings are not straight line across the board. What you're doing is the years where you make more net rental income, you are saving more on taxes. The years where you make less net rental income, you're saving less on taxes. In fact, if you don't make any net rental income in a year on a projection, which is possible in a year, maybe you have a property turn, at that point, you're not receiving any tax savings that year, because you don't save taxes when you show a net rental income loss. So one thing that just to know here, and then as you're going out and potentially looking at pro formas yourself, in a single family rental property, if you just see straight line the same number across tax savings, that's not an accurate calculation for it. So that's the first thing. What's happening here is they're likely doubling the tax benefits as well. This is also a very common thing. They basically assume that you are getting a much larger write-off than you really are. And I won't get into all the taxes. I tried to figure it out, but ultimately this is probably double the impact here, and it's just not completely accurate. Your tax savings actually go up and down over the years that you hold it, based on what your net rental income numbers are for those years.
Okay, so tax savings should be variable based on cash flow. It's not even like that as well. Michael Santorio says, Greg, something appears to be off. I don't know how he even got to like this page before we got here. So Michael Santorio must know something, he's figuring things out, but he went really deep here. He says something appears to be off on the taxes too. The pro forma showed taxes at 1% of the sales price in 1986. This property appears to be in Selby County, where the tax rate is $270 per $100 assessed value.
Oh, he's talking about property taxes.
For a tax bill to be 1986 at $270 per 100 assessed value, the assessed value would have to be $73,490 after selling for $198,600.
Yeah. So he's talking about property taxes. When we're talking about tax savings here, we're talking about income tax savings. So that's how he figured this out, because he's going back to the first page and he's looking at what are the estimated property taxes for the property. And he's saying it's way low. And that's probably a really good call. I actually didn't go and verify the property tax cost on this property. So good on you, Pedro Santorius. I mean, you're probably right there. I took their property tax number and I assumed it was right, but you know what? you shouldn't do that. You should follow what Michael's doing and go and fact check. So what he's doing is you can go and look at the public record and see what the tax bill is for a property. And I'm sure that's what Michael was doing here in the background. And it's a really good point. And another way of, unfortunately, overestimating or inflating the potential return on investment on the pro forma.
Good stuff. So let's talk about this loan payout amount, home sales revenue, selling, holding, closing costs.
Yeah. So here's where it got really funky. So thinking about principal pay down, they say loan payoff amount here. When you're thinking about building a pro forma, you gotta think about, okay, what amount of gain do I get and when does it hit my bank account? So when you actually are putting together a pro forma for and showing a principal pay down effect, you know, the money that came to you as the loan never hit your bank account. So it's not like you get an infusion of cash when you receive a loan on the property. And also when you pay the loan off, it's not a, exit of cash from your bank account. It's just the loan happened.
Yeah.
What's happening is you get a benefit from the loan pay down from your tenant or your resident paying that loan down for you.
Yeah.
And so
you get that back when you sell as like extra profit.
Exactly. Yeah. Exactly. So what they have here is this $119,000 as a cost at that point, which doesn't make any sense when you're running a pro forma.
Yeah.
I think they're just confused because that's not, while that is the loan payoff amount at that moment, that doesn't affect your pro forma. It didn't hit your bank account one way or another.
The loan isn't added in on the front end.
Exactly.
In these numbers.
Exactly. Yeah. So it's actually like a cost here, which is actually bringing their IRR down.
Okay.
Which is, again, doesn't make any sense to me. I actually ran what the principal pay down amount should be. And there's actually about $27,000 of principal pay down gain. So that negative 119 should actually be 27,000 positive instead of a $119,000 loss. So in this section right here, it's actually way lowering what their IRR projection is, but don't worry, they're going to inflate it somewhere else. So.
Got it. Interesting. Okay. That makes sense.
It's a new one, right?
Yeah.
It's like, I'm really happy that they're showing it in year 10.
Yeah.
They were so close to doing it right.
Yeah.
They're better than most, but not right.
Probably not a finance degree from University of Florida like you.
Go Gators.
Go Gators. All right. Home sales revenue. Why do you have that highlighted?
Well, here's just where you're incorrect and you're way overestimating on home price appreciation. So get this. You remember they talked about new construction home price appreciation in Memphis for this property being 8% home price appreciation per year. Well, I ran the numbers and that shows like a gain of revenue of $256,000 and change.
I would assume that that's the sales price when you sell.
But it's not. It's not. So if this is a pro forma, you shouldn't be showing revenue here. You should be showing your profit. Remember, when you're building a pro forma, it's all about how much profit did you make or loss did you make and when did it hit your bank account. So to calculate your home price appreciation effect, you look at the additive home price appreciation that hits when you sell in year 10. So they're confusing this. Again, they're putting home sales revenue, which makes me think of sales price, but it doesn't make any sense. In fact, when I actually ran the numbers, the sales price that they're assuming is actually $453,000 in order to put $256,000 of profit in your bank account when you sell. Does that make sense so far? Okay. So they're screwing this up. And that, to make it even worse, that $453,000 number isn't even 8% home price appreciation.
That's what I was about to say. That doesn't sound like 8% home price appreciation.
Well, it's 8.7% home price appreciation, gaining year over year and compounding over 10 years. So the number's not right. But this, you know how we talked about how they're way underrepresenting the principal pay down component.
Yeah.
Well, they are way overestimating the home price appreciation effect here by assuming that it's going to appreciate 8.7% per year. Again, like we talked about, the data says that historically Memphis has appreciated at a 3.2% rate year over year for average appreciation. So way overestimating home price appreciation here and just doing it incorrectly on what the pro forma should be built like.
Okay. And then since you just gave me a bit of a teaser of a 400 and something $1,000 sales price, selling and holding cost of 15K seems pretty low.
Yeah. So I ran that. If
Yeah.
what they are assuming is a sales price of 453,000 in order for this to be accurate, and if you assume only 15 grand in costs, that's just 3.4%. What's a typical real estate commission?
6%.
There you go. So they're only assuming 3.4%, and that's not even counting your a full real estate commission of 6%. Plus, you generally want to set aside 2% for closing costs on the sale and 2% for holding costs on the sale. So a 10% figure is what you should be accounting for. They only accounted for 3.4% here.
Okay. So again, a bunch of other underinflated things. We've got a couple of really good questions. I'm going to save them until the end because they have to do with comparing this to the JWB Pro Forma.
Yeah.
So we can talk about that. But again, what we talked about here is this idea of overestimating tax savings, which artificially increases the IRR projections. Incorrect calculations of principal pay down in IRR, incorrect and overestimated home price appreciation, and underestimated holding costs. So it's like really important that the pattern I'm seeing here is that you get shown a number on the front end and then you get shown a whole bunch of other numbers on the back end, and they're not really exactly matching up. So A, does the number match up? And B, if they're going to have these like low price things that, that don't pass the sniff test, they have to have really good explanations why, right? Like, I don't know, maybe this person's like, oh, okay, we work with a way that disposes of property that's only a 3% closing cost, and you don't pay the buyer thing, right? Like there just has to be an explanation for the stuff that doesn't pass the sniff test.
Absolutely. There's got to be an explanation. I just think being that client that says, walk me through each of these numbers is really, really critical. Not enough investors do that, but you'll find out if they know their stuff, if they have a good explanation, or if they just don't and they were just putting something on a pro forma.
Yeah. Yeah. Cool. Not Your Average Guest has something that's not pro forma related. They're asking, is 3.2% appreciation per year good?
Historically, across the entire United States, 4.5% is the average annual home price appreciation. So in many cash flow markets, they have lower home prices and they haven't experienced as much home price appreciation. So it is not 3.2% is not the average across the entire country. And you can find markets like Jacksonville and some other markets where you can produce positive cash flow and have above average home price appreciation. In Jacksonville, it's 4.8%. So if you're going to go towards a Memphis market, you are going way cash flow. You're giving up a lot of growth and leaving a lot of money on the table over 10 years because you won't get as much home price appreciation, most likely.
There you go. So this is you correcting the actual pro forma with your correct assumptions, right? So it goes from 487 a month in cash flow, estimated IRR of 13.7%, total profits with a 10-year hold of 107,418 to right sizing these things, $457 a month in cash flow. Not losing that much cash flow.
No.
12.9% estimated rate of return. Doesn't seem like a giant drop, but it is $10,000 less in total profits over a 10-year hold.
Yeah. Like we started by saying, like at the end of the day, they weren't that far off from what we would estimate their pro forma to be and their profits and rate of return. It's just the way they got there doesn't make any sense.
Got it. So, now the big thing is, we look at those like front end sheets and you look at the front end sheet of like the JWB Pro Forma and you're like automatically, oh, this is a better deal on the other one. Once you right size it and you look at the numbers equal, you see the Memphis turnkey property having a initial investment of $60,732, net rental income of $27,000 and change, tax savings of $6,700, principal pay down of almost $28,000, home price appreciation of $72,000, and total profits in year 10 of $97,355. In comparison to a JWB turnkey property, which is initial investment of $65,000, $5,000 more, right? That's not insignificant. Net rental income, $17,900. So that's 10,000, like 9,000 and change less rental income over the 10 years, right? So that's something to pay attention to. Tax savings about equal, right? $6,000 in tax savings. Principal pay down, yeah, slightly higher principal pay down. I assume that's because of the higher purchase price,
That's
right?
Higher amount.
Home price appreciation here. This is that question, right? Is 3.2% appreciation good versus 4.9? Home price appreciation of $136,000, which is $60,000, $64,000 more than the other, than the Memphis home. And that's kind of like the big difference here, right? Even though less cash flow month to month, your total profits in a Jacksonville investment over 10 years, 154,000 versus that $97,000. That's 47, $57,000 more over 10 years in one property.
Yeah, exactly. So there are pros and cons to each property, but at the end of the day, you have an ability to spend $5,000 more, earn a little bit less cash flow in the intermediary, and then make $57,000 more down the line. Maybe that's the right call for an investor out there. If you are an investor who wants maximum cash flow, then you might say, well, I'll spend $5,000 less. I might get $10,000 more of cash flow, but I'm going to leave a lot of home price appreciation on the table at the end of 10 years. That's why somebody would decide to go the Memphis route. JWB clients want the best of both worlds, which is you still get a lot of positive cash flow. It's not going to be $450 day one. It might be $200 a month in day one. But ultimately, at the end of the day, your rate of return on the dollars that you put out is much higher when you have both positive cash flow and significant home price growth over 10 years.
You see, I'm a buy and hold guy, right? So I'm not liquidating my property in 10 years,
right?
Right. So like this idea of like, I'm going to have $57,000 more in my pocket, not super real to me. But what is real to me is the idea that $57,000 of home price appreciation is now, or of extra pocket profits, is pretty close to the down payment of cash out, like a cash out refi that buys me another rental property and allows me to continue to grow my portfolio, right? So like the $10,000 in cash flow that I'm leaving on the table, over 10 years, an extra $1,000 a year isn't really going to change my life. Yeah. But if in year 10, this property is paying for another rental property for me that I can continue to compound as my rental portfolio grows, that's a very different equation for me.
That's how we change your life. That's how we change your life. It's that rhythm right there of buying an asset that pays for itself every single month, produces positive cash flow. You let all these wonderful things happen in the background, including home price appreciation. You get into a rhythm of maybe every 5 to 7 years, unlocking that equity and then having it create property babies and create assets that you are just reinvesting your own profits into. And that's how you go from a portfolio of 3 properties to 5 properties, 10 properties, 20 properties, but you didn't have to bring your own money to the table to do it.
Yeah.
And that's how we can really, really change your life. You don't get to do that at the same rate when you invest in a market that doesn't have as much home price appreciation.
Yeah.
So this model that we've really espoused and gotten a little bit more loud about of harvesting this equity, redeploying it, that's where a market like Jacksonville, which has higher than normal home price appreciation, is really built for that type of a model.
You see, I think if I was to add, I agree, right? Like, and I think the missing information here, if you're new to the show, and I feel like there's a whole bunch of new names, is the fact that we've looked at a whole bunch of other investor portfolios over time, and we break out the 5 profit centers in a pie chart. And every single time you see that home price appreciation is 60 to 80% of the return of the thing, right? So like this idea of like why we are so fanatical about understanding that you don't trip over the dollars to pick up pennies in cash flow, and you really focus on the home price appreciation as that lever that will continue to change your life becomes very, very real when you see it graphically represented over and over again. So maybe adding that like pie chart to this presentation next time we do a breakdown would be an interesting thing of like seeing it on the screen even, right? Of like the 2 investments side by side would be really, really interesting. And second of all is we're getting a lot of questions about the JWB Pro Forma. Maybe it's a time to do a deep dive into a JWB Pro Forma as well. Cause can I ask some of these questions here of the attendees? I know you don't have them in front of you. But one is anonymous asking, Can you show how your company includes or purposely excludes to not inflate returns, and clarifies all of this? I have seen cash flow numbers from JWB that didn't include maintenance and vacancy numbers.
Yeah, happy to do that. I think a deep dive would be great. We do include maintenance and vacancy numbers. So what we include are your occupied maintenance, so and then your property turn costs. So ultimately, what you're going to find on a JWB Pro Forma is that maintenance percentage, for a new construction home, it's 4% of the gross rents. Well, over a 5-year period of time, you've got 4% of the gross rents given back in terms of maintenance costs. That has always been on a JWB Pro Forma. So what you're going to see is that it spikes in the years where tenants move out. Yeah. So what wasn't included on this Pro Forma, you're going to see it on a JWB Pro Forma. So yeah, we absolutely include maintenance costs, vacancy costs, tenant placement fees, lease renewal fees, and it's all just tied to what our business activities and our metrics support. So I think it would be wonderful to be able to do a deep dive there.
Yeah. And MJ from NJ has a similar kind of question. When I look at your properties that are sent to me, the JWB portfolio generator doesn't show as a typical pro forma. I can't even see the things that you're discussing here over time, like the maintenance changing to match turns. And by the way, when I read the estimated rate of return on the JWB portfolio generator, I was told the number does include tax savings for a single tax bracket and can't be changed. That skews things, as you were speaking about.
Okay. Let me take the last one, and you'll have to remind me on the first part of that.
Yeah, I'll just put it up here on the screen.
Yes, tax savings are included in the JWB Pro Forma. We have it set at a 35% tax bracket. So yes, to your point, if you're in a lower tax bracket, then your tax savings would be lower than what is represented on the JWB Pro Forma. We have it at 35%. But yes, tax savings are accounted for, and they're accounted for the right way, where they vary based on when you actually receive net rental income. So absolutely accounted for. And if you're in a 35% tax bracket, then it equates for you. If you're in a different tax bracket, it's a little bit different for you. Can't remember the first part of the question.
When I look at your properties that are sent to me, the JWB portfolio generator doesn't show as a typical pro forma. I can't see some of the things that you're discussing here over time, like maintenance changing to match turns.
Yeah.
I remember that there used to be like you used to send deal sheets, and then you develop this like portfolio generator that allows you to like scale up and down in selecting things. Are they two different things?
We actually have made some really awesome improvements to the portfolio generator. So they actually have their own deal sheet as well. Okay. So MJ, I don't know the last time that you were able to sit down and look at our portfolio generator, but just in the last month or two, not only have we always had those things that you were just asking about, we have always had the pro forma, everything I just shared with you and broke down for the Memphis property. I compared it to our JWB Pro Forma. So we've always had all of those expenses in there, but now it's even more visible on an individual kind of deal sheet or individual property. You can see it broken down. So
when you say always had, you're saying the assumption was there, maybe MJ didn't have access to like the line item on it, or?
Well, so you can get a very numbers heavy. Yeah. And when you're thinking of building a portfolio of 3 properties or 5 properties or 1 property. So the pro forma has always been there, but many times when we're working with a client, we want to show the big picture first to make sure we're moving in the same direction. And so depending on the conversation with the client, we may get into the nitty gritty details to be able to look at, well, what's the tax savings on this property in year 3? We don't do that to start off every phone call because maybe that's not what that client needs at that moment in time, but it's always there. It's just, it has been a little bit more hidden as our portfolio generator has improved over the years. It's gotten more numbers heavy. And so we've hidden that. And then when the conversation is the right conversation to have with the client, maybe right before they're choosing a property to invest in, we'll say, hey, listen, let's break this thing down. Let's go and look at the nitty gritty details. So that's the way it has been. Now we've made some real improvements to make it even more visible and to reflect what a typical deal sheet would look like if you only looked at like the pretty picture in the front and like, the year 1 cash flow and some of these other things. So it's just a lot more user friendly to look at the individual property details now. So that was a long way of saying, if you haven't been on the phone with our sales team recently, jump on a call right now, because there's actually been some real process improvements that help you understand how an individual asset performs and the numbers behind it.
Okay. All right. So Mike Foster says in JWB's Pro Forma, tax saving projections when I bought 3 years ago that only included depreciation as the tax savings. Today, does JWB's tax savings projections now include additional expenses?
Let me just make sure I'm reading that. So when he bought 3, they only included depreciation. Today, he's asking if the projections include additional expenses. Mike, we've always assumed the write-offs when it comes to tax savings. It's just in a different location, so like your gross rental income is, or your expenses are deducted from your gross rental income, and then that shows up as a reduced taxable net rental income number. So that's always been there. It just hasn't shown up as like tax savings. It's sort of implied.
Mm-hmm.
And so 3 years ago, when you saw the depreciation expense on the tax savings line, that's just specifically talking about the depreciation write-off. So I know I'm getting real technical and like nitty-gritty details here, but it's always been there. Your additional expenses have always been able to be written off against your gross rental income, and it shows up as a reduction of taxable income for net rental income. If you guys are confused, jump on the phone with the sales team. We're happy to walk you through it.
Sounds good. And then Patient Santorios has a question as a well-informed member of our community. Greg, what about downtown Jacksonville development, Gateway Jacks plus Per Square, et cetera, versus Memphis? What's he talking about?
Oh man, I'm beyond anything on this pro forma. We think the best is yet to come when it comes to Jacksonville's home price appreciation. And I'm not an expert in the Memphis market, but I feel pretty good about saying they don't have anything nearly as exciting as the downtown revitalization that is happening here in Jacksonville. For those who aren't aware, Pearl Square is the entire new neighborhood in downtown Jacksonville that Gateway Jacks is developing. JWB is an equity sponsor of Gateway Jacks, and we basically set up this investment fund that is going to build a brand new neighborhood in our downtown.
Within downtown.
Within downtown. I actually was just walking it last week with a potential client. Guys, for everybody who's coming to Summit next year, like your minds are going to be blown. Like the amount of construction that's happening now. And I took Linda Evans on a tour. Maybe Linda can chime in. She was here at Summit earlier this year, and the amount of construction, the amount that's being developed now when it comes to the new Publix that will be there, the parking garages look completely different. We're almost finished with our brand new building. It's really, really happening. It's really exciting. So to Michael's point, like, what does this mean as far as your home price appreciation and your evaluations? This is another under promise and over deliver element when it comes to investing in Jacksonville and with JWB, because we are not factoring that into your home price appreciation expectations or your rent price appreciation expectations. We're just doing what's been done for the last 40 years when it comes to your average appreciation rate. So it's an under promise and over deliver type opportunity to be investing in the next great American downtown. And when you invest with JWB and you invest in Jacksonville, you have that huge opportunity to overperform for your portfolio.
Good stuff. Good stuff. All right, GC. I think we should do a portfolio generator and deal sheet. MJ is saying that he'd love to see a JWB generator that includes a traditional pro forma as well, and he's been looking in the last week and having a hard time finding it. So
perfect.
I think MJ, like we say, we like to make these shows based on community feedback. We hear you loud and clear. You can definitely look forward to in the next 4 to 6 weeks we do something exactly like that.
Game on.
And we'll do that for sure. Linda Evans says, "Oh my, what a growth that is happening just since February, which is our last summit. I can see a tremendous amount of construction that is almost finished and more that is happening too." Yeah.
It was really fun spending some time with Linda and her friend Chrissy. So thanks for validating it, Linda.
Awesome, GC. Well, we're a little bit over, so we're gonna end this. I want to thank the community. We had 80 plus folks. We had a whole bunch of new names. I hope that you had a good time. I hope that you're using this chat to. I don't get to follow the chat the entire time when I'm engaged in conversation, but you're using the chat to talk to each other and verify things and go back and forth and things and such. You can connect personally with people in the chat as well. But more than anything, hope you feel comfortable coming here, being educated, learning some new questions to ask, peppering us with new questions so that we can continue to develop this content program, because it's all about you taking an hour of your day in the middle of the work week to get yourself educated, that we never, never, never take for granted. We want to continue to bring you the things that matter to you, help you make great decisions, provide for a better retirement, provide for better savings and investment strategies. And hope you join us next week. GC, up until from now till then, any advice for our community?
Don't be average. See you,
Till
everybody.
next week.